All right, welcome everyone to another deep dive. Today we're going to be talking about something that I think affects everyone in India, our income tax system.
Yeah, that's right. It's something we all have to deal with.
We have a lot of information straight from the Income Tax Act of 1961,
That's right.
and we're going to try to sort of break down two big things: how to potentially reduce, make sure that you're paying the right amount at the right time
Yeah.
so you don't get in any kind of trouble. So basically, just to give you a clear picture of what's going on, a clear understanding of some of these essential elements of the system.
Yeah, absolutely. So there's several things that we'll look at in this deep dive.
Okay.
We're going to start off with this thing called a rebate,
Okay.
which is found under Section 87A. Now, this is like a discount.
Okay.
If your income is, let's say, below a certain level,
Okay.
you can get a discount on your taxes.
That sounds good.
Yeah. Then we will move on to this complicated area of provident funds and superannuation funds.
Okay.
And we'll discuss what are the tax implications
Okay.
when you withdraw from your provident fund or, when you receive money from your superannuation fund.
Okay.
Then we will discuss the role of the person who deducts your tax from your salary. So every month, a certain amount is deducted from your salary.
Right.
Who's that person? What are they called? What are the responsibilities? What do you need to provide them to make sure that that tax deduction is accurate?
Okay.
And then finally, we will talk about these concepts of advanced tax and self-assessment tax,
Okay.
which is, apart from this TDS,
Yeah.
how do you pay tax?
Right.
How do you ensure that you pay it on time?
Okay, so let's start off with this Section 87A, this rebate that you were talking about, this tax rebate. So what exactly is this? What's it all about?
Okay, so Section 87A essentially provides a tax reduction. So as I said, it's like a tax discount, and it's available to resident individuals in India
Okay.
whose total income does not exceed a certain limit.
Okay.
So it's basically aimed at reducing the tax burden
Okay.
on individuals who have a relatively lower income,
Okay.
so giving them some relief.
Okay. So what are the specific conditions someone would need to meet to actually be eligible for this rebate? What are the must-haves?
Okay, so there are a few eligibility criteria.
Okay.
First of all, you need to be a resident individual in India
Okay.
during the financial year for which you're claiming this rebate.
Okay.
So it is not for non-residents.
Okay.
Second, your total income, and this total income is after you have, let's say, availed of any deductions
Right.
that are available under Chapter VIA. So
Okay.
Chapter VIA has various sections,
Okay.
from Section 80C to 80U, which allow you to reduce your taxable income by,
Okay.
making certain investments or incurring certain expenses. So once you have claimed all those deductions,
Okay.
your total income should be below a certain limit.
Okay. So there's a limit, there's like an income ceiling then.
Yes, there is an income ceiling. And this income ceiling is different based on whether you're following the old tax regime
Okay.
or the new tax regime.
Right.
Okay, so for the assessment year, let's say 2024-25,
Okay.
which relates to the income that you earned in the financial year 2023-24,
Right.
the limit under the old tax regime is 5 lakhs.
Okay.
But under the new tax regime, the limit is 7 lakhs.
Okay. So it's higher under the new regime.
Yes, it's higher under the new tax regime.
Okay. And this can change, these numbers can change every year.
Yes, these limits, they are not fixed.
Okay.
They can change every year based on the Finance Act.
Okay. Got it. So those are two of the conditions, the residency and the income limit. Anything else about who can and cannot claim this?
Yes, this rebate is only for individuals.
Okay.
So if you're filing your tax return as an individual,
Oh.
and if you meet the residency criteria and you meet the income criteria,
Okay.
then you might be eligible.
Right.
But if you are, let's say, an HUF,
Okay.
Hindu Undivided Family, or an AOP, Association of Persons, or a body of individuals, or a firm or a company,
Right.
then you cannot claim this.
Okay. Got it. So let's say, hypothetically, I meet those conditions. How do we actually work out how much rebate I would get? What's the math behind this?
Okay, so the amount of rebate that you get is the lower of,
Okay.
1, the income tax that is payable
Okay.
on your total income for that assessment year
Okay.
before adding the health and education cess.
Okay.
So you calculate your income tax,
Okay.
but you don't add the cess yet.
Right.
And the second thing is a maximum prescribed amount.
Okay. And then that maximum amount, is that also different for the old and new regimes?
Yes. just like the income limit.
Right.
The maximum rebate amount is also different under the old regime
Okay.
and the new regime. For the assessment year 2024-25, if you're following the old tax regime, the maximum rebate is 12,500 rupees.
Okay.
And if you're following the new tax regime, the maximum rebate is 25,000 rupees.
Okay. And again, this can change.
Yes, these amounts can change every year.
Okay.
Based on the Finance Act.
Okay, so it's the lesser of the two. So can you maybe walk us through an example just to make this completely clear?
Yeah, sure. So let's say your total income is 4,80,000 rupees.
Okay.
And you are following the old tax regime.
Okay.
So 4,80,000 is below the 5 lakh limit.
Right.
So you are eligible for Section 87A rebate.
Okay.
Now, let's say after applying the tax slabs and rates,
Right.
your income tax payable on 4,80,000 comes out to be 10,000 rupees.
Okay.
Okay, before cess.
Right.
Now you compare this 10,000 rupees with the maximum rebate,
Right.
which is 12,500
Right.
under the old regime.
Right.
Okay, the lower of the two is 10,000.
Right.
So your rebate is 10,000.
Okay.
You deduct 10,000 from 10,000.
Right.
Your tax payable becomes 0
Okay.
before cess.
Right.
Then you add the 4% cess on 0.
Right.
Which is also 0, so effectively you pay no tax.
Wow. So that's great. If you qualify, basically you could end up paying no income tax at all.
Yes, that is the benefit of this rebate.
That's a big benefit.
Yeah, that if your tax payable before cess is equal to or less than the maximum rebate,
Okay.
and if your total income is within that limit,
Right.
then you pay no tax.
Okay. Fantastic. Okay, let's shift gears a little bit. Let's talk about TDS.
Yeah.
Tax deducted at source.
Right.
On withdrawals from provident funds
Right.
and superannuation funds.
Yeah.
This is an area that's always seemed kind of very complex.
Yeah, it can be a little, intricate, but let's try to break it down.
Yeah, let's try to make it easy to understand.
Okay, so TDS applies to certain withdrawals,
Okay.
particularly from recognized provident funds, or RPF. And it also applies under specific conditions
Okay.
to approved superannuation funds.
Okay.
Now, it's important to note that withdrawals from Public Provident Fund, PPF,
Okay.
and Statutory Provident Fund, SPF,
Okay.
they are treated differently.
Okay.
And they are, in most cases, tax exempt.
Okay. So PPF and SPF, we're not really going to talk about those today.
No, we'll focus on RPF
Okay.
and superannuation funds.
Okay, great. So when it comes to RPF, when does a PF withdrawal actually become taxable?
Okay, so the general rule is that your RPF withdrawal
Okay.
becomes taxable if you have not completed 5 years of continuous service
Okay.
with the same employer,
Okay.
okay, who is maintaining your PF account.
Okay. With the same employer who's maintaining that PF account. Okay. But are there any exceptions to that 5-year rule?
Yes, there are exceptions.
Okay.
Even if you have not completed 5 years of continuous service,
Okay.
your withdrawal might still be exempt. If the reason for the termination of your employment is, let's say, your ill health,
Okay.
or the discontinuation of your employer's business,
Okay.
or any other reason beyond your control,
Okay.
okay, and also if, let's say, you change jobs
Right.
and you transfer your PF balance
Okay.
from your previous employer
Okay.
to your new employer's PF account,
Right.
that transfer is exempt.
Okay. So that's important. So when you change jobs, even if you haven't completed 5 years with a previous employer,
Correct.
that transfer to the new employer is not taxable.
Yes.
Okay, that's really important. Okay, so then in what specific situations will TDS actually be deducted from my PF withdrawal?
Okay, so TDS will be deducted under Section 192A
Okay.
on the taxable portion of your RPF withdrawal
Okay.
if two conditions are met.
Okay.
1, you have not completed 5 years of continuous service,
Okay.
and the withdrawal does not qualify for any of those tax-exempt scenarios.
Right, that we just discussed.
Yeah. Okay.
And second, the amount of withdrawal is 50,000 rupees or more.
Okay, so if I haven't been with the employer for 5 years and I'm taking out more than 50,000 rupees, that's when the TDS kicks in.
Yes.
Okay. And what are the rates at which TDS is actually deducted from this withdrawal?
Okay, so the rate of TDS depends on whether you provide your PAN, your permanent account number.
Okay.
If you provide your PAN, then the rate of TDS is 10%.
Okay.
But if you don't provide your PAN, then TDS is deducted at the maximum marginal rate,
Oh, wow.
okay, which is currently 30% plus surcharge
Okay.
plus 4% cess.
Wow. So Big difference whether you give your PAN or not.
Yes. Huge difference.
Okay, so definitely always give your PAN. And so when we're talking about this PF withdrawal, what parts of my withdrawal are actually considered taxable?
So the taxable part of your withdrawal is the employer's contribution
Okay.
and the interest earned on the employer's contribution
Okay.
and also the interest earned on your own contribution.
But your own contribution is not taxable
Okay.
because that contribution comes from your salary, which has already been taxed.
Got it. Okay. Are there any forms that people should be aware of when it comes to PF withdrawals and TDS?
Yes, so there are a couple of important forms.
Okay.
First, when you apply for withdrawal,
Right.
you will typically need to fill out Form 19.
Okay.
And second, if you anticipate that your total income for the year will be below the taxable limit,
Okay.
then you can submit Form 15G if you're below 60,
Okay.
or Form 15H if you're a senior citizen, to the PF Trust.
Okay.
And this is basically a request to the PF Trust to not deduct any TDS.
Okay. So if my income is going to be below that threshold,
Yes.
I can submit one of those forms
Sure.
to avoid the TDS.
Yes.
Okay. That's good to know. Let's switch over now to superannuation funds.
Okay.
So first, what are these and how are they different from provident funds?
So a superannuation fund is a retirement benefit scheme
Okay.
set up by an employer. It's
Yeah.
officially recognized, approved by the Commissioner of Income Tax,
Okay.
and it provides pension to employees upon retirement.
Okay. So it's also for retirement, just like a provident fund.
Yeah, it's also a retirement savings, option,
Okay.
and it's specifically designed to provide a pension.
Okay.
So there are specific rules that govern the taxation
Okay.
of contributions to these funds,
Okay.
the interest earned, and the payments made from these funds.
Okay, so let's take those one at a time. So how are contributions to superannuation funds treated tax-wise?
Okay, so contributions to superannuation funds,
Okay.
the employer's contribution
Okay.
is exempt from tax in the hands of the employee,
Okay.
but up to a limit of $1,50,000 per year.
Okay.
So if the employer contributes more than $1,50,000
Okay.
in a year,
Okay.
then the excess becomes taxable
Okay.
for the employee
As-
as a perquisite
Okay.
under the head salaries.
Okay. Got it.
Now, the employee's own contribution
Okay.
to the superannuation fund qualifies for deduction under Section 80C.
Okay.
But this is subject to the overall limit
Okay.
for Section 80C,
Right.
which is $1,50,000.
Okay. So 1.5 lakhs all in for everything under 80C.
Yes, that's correct.
Okay. What about the interest that's earned?
The interest that is credited to the superannuation fund balance
Okay.
is generally exempt from tax
Okay.
as it accrues.
Okay. So it grows tax-free.
Yeah, it grows tax-free.
Okay. And when we get to actual payments from the fund, when are those taxed and when are those not taxed?
Okay, so payments from the superannuation fund, they are exempt from tax in several cases.
Okay. Okay.
So one, if the payment is made upon the death of the beneficiary.
Okay.
Two, if the payment is made to you on retirement
Okay.
at or after a certain age
Okay.
or due to incapacitation
Okay.
before retirement.
Okay.
Three, if a refund of contribution is made on the death of a beneficiary.
Okay.
And four, commuted pension.
Oh, okay. And what's that?
So commuted pension is a lump sum payment
Okay.
that you can choose to receive
Okay.
instead of a periodic pension.
Okay. Got it.
So this is exempt from tax up to certain limits,
Okay.
similar to the rules for gratuity.
Got it. Okay. So those are all the tax-free situations. When did the payouts actually get taxed then?
Okay, so the payments become taxable in a few cases.
Okay. Like what?
So one, if you withdraw from the fund before retirement
Okay.
for reasons other than death or incapacitation.
Right. So if you take it out early for other reasons.
Yes.
Okay.
Two, if the payment is made in violation of the fund rules.
Okay.
Three, if a refund of your own contribution
Okay.
is made before retirement.
Okay.
And four, the portion of commuted pension.
Okay.
That exceeds the exemption limit.
Okay. Got it. So those are the situations where you would have to pay tax. And does TDS apply to those taxable situations?
Yes, if the payment from the superannuation fund is taxable,
Okay.
then TDS will generally be deducted.
Okay.
Now, the section under which TDS is deducted
Okay.
depends on how that payment is classified.
Okay.
So typically, it will be deducted under Section 192,
Okay.
which deals with salary income.
Okay.
but other sections might also apply.
Yep.
The rate of TDS will depend on the nature of payment
Okay.
and your tax slab.
Okay, got it. So that's kind of the overview of those two types of retirement funds. Let's move on now to the role of what's called a DDO,
Okay.
a drawing and dispersing officer,
Yeah.
and their responsibility in, verifying that the claims that we're making to save on taxes are actually legitimate and have some evidence.
Yeah.
So what are the key responsibilities of a DDO when it comes to this?
So DDOs play a very important role in the TDS system,
Okay.
particularly, for deducting TDS from salaries.
Right.
This is under Section 192. So their responsibilities are quite broad.
Okay, so can you walk us through those key responsibilities?
Yeah. So they are responsible for calculating the TDS.
Okay.
That need to be deducted every month
Okay.
from the employee's salary.
Right.
And this calculation involves estimating the employee's total income.
Right, for the year.
Yeah, for the whole year.
Okay.
Taking into account their salary,
Right.
their allowances,
Right.
any perquisites,
Okay.
and any deductions or exemptions that the employee is claiming.
Okay.
The second important responsibility is that they need to verify the genuineness
Okay.
of the claims made by the employees for various exemptions, such as HRA, LTA,
Okay.
and deductions under Chapter VAA.
Okay.
So they need to make sure that the employee's claims are genuine and correct,
Right.
and they're supported by evidence.
So they can't just take my word for it that I'm paying this much rent or I've made this investment.
Yeah, they can't just accept your word. They have to actually, see the proof.
Right.
Then their third responsibility is to deduct the TDS
Right.
every month
Yeah.
from the employee's salary.
Okay.
Then they have to deposit this PDS with the government
Okay.
by the 7th of the next month.
Okay.
Then they have to file quarterly TDS returns
Okay.
electronically.
Okay.
This is using Form 24Q.
Sorry.
And they also need to issue Form 16, which is an annual TDS certificate
Yeah.
to the employee by a certain due date.
Okay.
And finally, they are responsible for ensuring overall compliance with all the provisions of the Income Tax Act,
Okay.
as well as maintaining all the records
Okay.
related to, salary payments, TDS deductions,
Oh,
and so
yeah.
on. Okay.
So quite a lot of responsibilities. And you were talking about having to verify employee declarations.
Yeah.
Can you give some more detail about what kind of proof a DDO is looking for?
Yeah. So this verification process is a legal obligation
Okay.
on the DDO.
Okay.
They have to make sure that the exemptions and deductions claimed by employees
Okay.
are legitimate and are backed by evidence.
Okay.
Now, this is to protect both the employee
Okay.
and the DDO.
Okay.
To prevent inflated claims,
Okay.
to ensure that the correct tax is deducted,
Right.
and to protect the DDO or the employer from any penalties.
Okay. So for example, when someone's claiming HRA exemption, what kind of proof would they have to give their DDO?
Okay, for HRA, they would need to submit a declaration stating how much rent they're paying, address of the property, landlord's details,
Okay.
and to support this, they would need to provide rent receipts.
Okay.
Now, if the rent exceeds 1 lakh rupees per year,
Okay.
then the landlord's PAN is also required.
Okay. What about LTA? If someone is claiming LTA.
For LTA, initially the employee will declare their intention to travel
Okay.
at the start of the block period.
Okay. And what's a block period?
So the block period is a 4 calendar year period,
Okay.
okay, for which the LTA exemption could be claimed.
Okay. Got it.
So you declare your intention to travel.
Okay.
Then after you've completed the travel,
Okay.
you need to submit proof of travel,
Okay.
such as tickets, boarding passes,
Okay.
to the DDO.
Okay.
And the exemption is limited to either the actual travel expense or the LTA amount, whichever is lower.
Okay. And are there rules about what kind of travel can be claimed under LTA?
Yes, the travel has to be within India,
Okay.
and for, let's say, the employee and their family.
Okay. So no international travel for LTA.
Correct.
Okay. Got it. What about the deductions under Chapter VAA?
Okay, so for Chapter VAA deductions,
Yeah.
the DDO will need, documents to support your claims.
Right.
So, for example, for ADC, you would need to provide proof of investment.
Okay.
So this could be LIC premium receipts,
Okay.
PPF deposit slips, ELSS investment statements,
Okay.
tuition fee receipts, home loan principal repayment statements, NSC certificates.
Okay. So lots of different possible documents depending on what you're investing in.
Yeah, right.
What about ADD? What would you need for that?
For 80D, you would need to provide health insurance premium payment receipts.
Okay, and for ADE?
For 80E, which is interest on education loan, you need a certificate from your lender
Okay,
stating the amount of interest paid.
okay,
For 80G, which is donations,
okay,
you would need to provide donation receipts
okay,
with details of the don, like name, address, PAN, registration number,
okay.
and the amount.
Wow, they really need all that information on those receipts.
Yeah, they need to have all the details.
Okay, and for those ADTTA and ADTTB?
For 80TTA and 80TTB, which is interest on savings bank accounts,
Right.
you would need to provide your bank statements or a certificate from the bank
Okay,
showing the interest earned.
got it. And what about interest on a housing loan? How do I prove that to my DDO?
Okay, so for interest on housing loan,
Okay,
which is under Section 24B,
okay,
you would need to provide a certificate from your lender, which could be a bank
okay,
or a housing finance company.
okay,
And this certificate will state the amount of principal
okay,
and interest paid during the year,
okay.
as well as the lender's details, like name, address, and PAN.
Okay, so it sounds like the usual procedure is that at the beginning of the financial year, I kind of give my DDO an idea of what I'm planning to invest in or what expenses I'm going to have that might qualify for deductions.
Yep. Yeah.
And then towards the end of the year, I give them the actual proof.
Yeah, that's the general procedure.
Okay, so like in January or February, I have to scramble around and get all those documents together.
Yeah.
Okay, got it. Now, how does a DDO actually go about figuring out how much income tax they're going to deduct from my salary every month? It seems like a pretty complicated calculation.
Yeah, it can be complicated.
Yeah.
But basically, the TDS on your salary is calculated based on an estimation of your total income
Okay.
and your tax liability for the entire financial year.
Right. Okay.
So this annual tax liability is then divided
Okay.
and deducted proportionally every month.
Okay. Got it. Can we break down that process step by step?
Yes, sure.
Okay. So step one.
So step one is to estimate your gross salary.
Okay.
So this would include all the components of your salary like basic DA, HRA, LTA, bonus, any other allowances,
Okay.
perquisites, arrears, advanced salary.
Wow. So they take everything into account.
Yeah, everything.
Okay.
Step two.
Step two is to determine the exempt allowances. Host speaker.